Did you know that China's construction industry and banking sector are facing unprecedented challenges today? With over $1.5 trillion in debt, massive defaults by major construction giants, and a real estate market in turmoil, the situation is critical. In recent decades, China's economy transformed from a largely agrarian society into a global industrial powerhouse. Fueled by massive infrastructure projects, a booming manufacturing sector, and an expanding urban population, China's GDP growth rates have consistently outpaced those of most developed nations. This rapid ascent led many experts to predict that China would soon overtake the United States as the world's largest economy. However, this optimistic outlook is now in question. The construction industry, once the engine of China's economic growth, faces significant challenges. Major construction companies are drowning in debt, resulting in widespread defaults and unfinished projects. Simultaneously, the banking sector grapples with rising non-performing loans and financial instability. These issues have far-reaching implications not only for China's economy, but also for the global economic landscape. In this video, we'll explore the root causes of these crises, their long-term effects, and why these developments might hinder China's ambition to surpass the American economy. Welcome to Satoshi Finance, where we break down complex finance topics to educate and empower you on your journey to financial freedom. Today, we dive deep into the alarming trends of failing banks and construction giants in China, exploring their ripple effects on the global economy, and questioning whether China can still fulfill its ambitious goal of surpassing the United States economically. Stay tuned as we uncover the hard-hitting facts and expert insights in this eye-opening journey. China's construction boom, which began in the late 20th century, was characterized by rapid urbanization and massive infrastructure projects that transformed the country's landscape. The government invested heavily in building cities, roads, bridges, and railways to support its growing urban population and stimulate economic growth. Major construction companies like Evergrande played a pivotal role, undertaking ambitious projects that included residential complexes, commercial buildings, and even entire new cities. This construction frenzy contributed significantly to China's GDP growth, creating jobs and fueling related industries. However, the very factors that spurred the boom also led to its downfall. Over-leveraging and debt accumulation became rampant as companies borrowed heavily to finance their projects. The relentless pursuit of growth resulted in the creation of ghost cities, vast urban areas with minimal occupancy. Additionally, the growth was unsustainable, as it was driven more by speculation and investment than by actual demand. In response to these issues, the Chinese government implemented tighter regulations and policies aimed at cooling the overheated market. These measures, while necessary to prevent a financial meltdown, further strained construction companies already struggling under massive debt loads, leading to defaults and unfinished projects. This combination of over-leveraging, unsustainable growth, and regulatory tightening marked the decline of China's once mighty construction sector. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. China's banking sector has long been dominated by state-owned banks, which play a crucial role in supporting the nation's economic policies and development goals. These banks have been instrumental in financing large-scale infrastructure projects and providing credit to key industries, effectively acting as the financial backbone of China's rapid economic expansion. However, alongside these state-owned giants, the shadow banking sector has also grown significantly. Shadow banking involves non-traditional financial institutions that operate outside the regular banking system, offering alternative credit options to businesses and individuals. This expansion has been driven by the need for more flexible and accessible financing solutions, especially for those unable to meet the stringent requirements of traditional banks. Despite its contributions to economic growth, China's banking sector now faces significant challenges. One of the most pressing issues is the rise in non-performing loans, NPLs. As many borrowers struggle to repay their debts, the proportion of bad loans has increased, putting immense pressure on banks' balance sheets. This surge in NPLs has led to financial instability, with liquidity issues becoming more frequent as banks grapple with the mismatch between their assets and liabilities. In response to these growing concerns, the Chinese government has stepped in with bailouts and other interventions to stabilize the financial system. However, these measures, while providing temporary relief, have not fully addressed the underlying structural problems. The ongoing financial instability and the need for continuous government support highlight the vulnerabilities within China's banking sector and raise questions about its ability to sustain long-term economic growth. The downturn in China's construction and banking sectors has had significant long-term effects on the country's economy, particularly in the real estate market. Property values have plummeted as a result of widespread defaults and an oversupply of unsold homes, leading to substantial losses for both developers and homeowners. This decline in property values has eroded consumer confidence, making individuals more cautious about spending and investing. As a result, the reduced consumer spending has further dampened economic growth, creating a negative feedback loop that continues to stifle the real estate market and broader economy. Beyond the real estate market, the economic implications of these crises are far-reaching. China's GDP growth has slowed, marking a stark contrast to the rapid expansion seen in previous decades. The construction industry's struggles have also led to job losses and increased unemployment, which poses a threat to social stability. Additionally, the financial instability within the banking sector exacerbates these issues, making it more challenging for businesses to secure financing and invest in growth opportunities. The effects of China's economic troubles extend beyond its borders, impacting global markets. Supply chain disruptions have become more common as Chinese companies, facing financial constraints, scale back production or fail to fulfill their commitments. This has caused delays and increased costs for international businesses that rely on Chinese manufacturers. Furthermore, the economic slowdown and financial instability have made China a less attractive destination for foreign investment, leading to reduced capital inflows. The uncertainty surrounding China's economic future also affects global trade, as countries that are heavily dependent on Chinese demand for their exports face the risk of declining sales and economic downturns. When comparing China's economy to that of the United States, several strengths of the American economy stand out. One of the most significant advantages is its diversified economic structure, which includes a robust mix of industries such as technology, finance, healthcare, and manufacturing. This diversification fosters innovation and resilience, allowing the economy to adapt to changes and recover from downturns more effectively. Additionally, the United States benefits from a strong financial system characterized by transparent regulatory frameworks and well-established institutions that ensure market stability and investor confidence. Higher consumer spending, driven by a culture of consumption and a strong labor market, further propels market-driven growth, making the American economy one of the most dynamic in the world. In contrast, structural differences between China and the United States highlight the challenges China faces in achieving similar economic stability and growth. The political system in China is centralized and state-driven, with significant government intervention in economic activities. This approach contrasts sharply with the more market-oriented and decentralized economic policies of the United States, where private enterprise plays a crucial role in driving growth and innovation. Furthermore, the two countries have varied approaches to handling economic crises. While the U.S. relies on a combination of monetary policy, fiscal stimulus, and regulatory oversight to manage economic downturns, China often resorts to state-directed investments and interventions, which can lead to inefficiencies and long-term imbalances. These structural differences underscore why China, despite its rapid growth, may struggle to replicate the sustainable and diversified economic success of the United States. Given the numerous challenges China faces, it may not be able to overtake the U.S. economy as previously predicted. The construction and banking sector crises have led to significant financial instability, decreased consumer confidence, and a slowdown in GDP growth. These issues have broader economic implications, including increased unemployment and social instability. Additionally, the structural differences between China and the U.S., such as their distinct political systems and approaches to economic management, further complicate China's path to surpassing the American economy. Experts and financial analysts have expressed similar concerns. For instance, renowned economist Nouriel Roubini has pointed out that China's heavy reliance on debt-fueled growth is unsustainable in the long term. Similarly, financial expert George Magnus highlights that China's demographic challenges, such as an aging population and shrinking workforce, will also hinder its economic prospects. These expert opinions underscore the systemic issues within China's economy that may prevent it from achieving its ambitious goals. In conclusion, while China's rapid growth over the past few decades has been impressive, its current economic challenges and structural weaknesses raise doubts about its ability to overtake the US economy. The ongoing financial instability, coupled with broader demographic and policy issues, suggests that China's economic future may be less certain than previously thought. As we move forward, it will be crucial to monitor how China addresses these challenges and whether it can implement sustainable reforms to stabilize its economy. As the world's second-largest economy, China's ability to navigate these challenges will influence global markets and economies worldwide. Addressing these issues requires thoughtful reforms and strategic adjustments to ensure sustainable growth and stability. It also invites a broader discussion on the future of economic governance and international relations. Your thoughts on these topics are valuable. We encourage you to leave comments, share your perspectives, and engage in dialogue about the implications of China's economic trajectory on the global stage. Together, we can deepen our understanding of these critical issues and their potential impact on the world economy. If you found this video helpful, don't forget to give it a thumbs up. Subscribe to our channel for more insightful content and hit that notification bell so you never miss an update. Thanks again for watching, and I'll catch you in the next video.